Hello everyone and thanks for joining me in Fundamental Signals. Today I'm going to talk about Netflix and we're going to go over some of the fundamentals, some of the metrics to see if Netflix worth buying right now at these current prices. Alright, so first thing we're going to look at now is the revenue and the revenue forecast. As you can see in this chart from 2004 up until now, Netflix revenue has been growing consistently, and then the stock price has been growing with it. Now, looking at this and looking at the forecasted revenue, and we see it's still going up. So things looking good based on consensus and based on the predictions for the future. But what I want to show you here is that the stock price and the revenue, operating income, or cash per share, they all had very nice correlation, linear correlation for this from 2004 up until now, right? So you can see this correlation 0.93, 0.92, 0.91, 0.89. So looking at this, we can conclude that overall the stock price has been following the revenue or the cash per share or EPS, and you can see there are different metrics here, but what I want to focus right now is revenue. It's been following revenue, and in the past 10 years, past 5 years, and past 3 years, this has been intact. So 0.82, 0.85, 0.89, these all very nice correlation between stock price and the revenue. Now look at it in the past year. It's negative 78. That means the stock price has not been keeping up with the revenue growth, right? So that's the sign to me of undervaluation of this stock. If I look at this indicator, which is revenue momentum oscillator, that basically exactly what it shows. Whenever stock price is not following the revenue growth, you get these signals here, right? So we can see every single time we got these green signals, it means stock is at this discount, right? Now, that doesn't mean as soon as it gets green or as soon as you have this deviation, the stock price gonna shoot up like the next day. It's not like that, right? So it's like a long-term process. But what it shows me is that over time, like if you look at the stock price from the beginning up until now, these were the right moment to buy if you want to buy Netflix, right? So look at it here from 2004 to 2005, right? So you can see this dip in the stock price, and we see that this oscillator, it's showing us a green signal, meaning stock price is going down, but revenue is going up. And history shows us that that was a nice opportunity to buy into Netflix. And after that, we can see this rally from 0.15 up to 0.36, right? And that it basically became overvalued when you get this red signal. This oscillates between this green and red, and we can see right now we are in the green. And if I zoom in here, we see recently we've been in green since January 2026. Basically, actually, we came up here, so coming up, yeah, before that it was October, which was still red technically, but then stock going down. We see that right here, we get this deviation between stock price and the revenue growth. So that is showing me long term this is a good investment at this moment at these prices, because prices are not catching up with the revenue growth. Now we can see that with the statistics as well. So these are some scenarios that you can go over. So if you DCA into stock, and it doesn't mean the DCA, you know what it means, right? So you have to keep buying in. So if you DCA into this stock when this indicator is above 10 or above 20, above 30, and then sell it when it's below negative 10, negative 20, negative 30, meaning the red zone, you can see on average how much money you would make in the past, right? So this is in the past, and this is the average days you would have waited for the whole setup to play out. You DCA when it's green, and you get out when it goes to red. And you can see you get 55% return, 63% return, or 85% return. And these are the average days that you have to wait. So the first one is basically you have to wait for a year, and I don't know, let's say 3 months, and so on. And you have this win to lose ratio, meaning the first and the third scenario you won't lose any money, never. Like every single setup 9 times and 6 times you would always win. And you can see here you basically 88% of the time would win more than 15%. Well, the average is 55, and only one time, which is 11%, you would get 5 to 15%, right? So this shows me that maybe this is a good time if you want to invest in Netflix. But you need to pay attention to this point that you should DCA into the stock. You should not just buy one right now and then forget it, because the price can stay in this green zone and they might bleed for a long time. So what's important is basically you have to just keep buying to bring down your average price, right? So that's one thing I want to show you. Another interesting thing about I think the Netflix stock is the price to sales ratio. So this indicator is basically showing us how the P/S ratio is against its own 2 years average, right? So on average, if P/S ratio for Netflix is 30, let's say, right? If right now it's going on 25, then it shows an undervaluation. So it basically compares the stock current P/S ratio to its historic ratio, last 2 years ratio, right? All right, so let's see how this indicator actually did in the past. Again, we can see each single time the price dipped, we see this green indicator, right? So right here in 2004 again to 2005, we see that indicator turn green, meaning stock is undervalued based on P/S ratio. And another time we saw that in 2006, 2007 actually, and here in 2012, we have it in 2019, and we had this big dip into the stock price from 2022. In 2022, basically, the whole 2022, it was green. So you can think of it as like the price goes from 53 all the way down to what is it here, like 20, right? So it's all in green zone. So you cannot just buy in again at 53 and think you are buying the dip. That's not a dip. So the prices can stay low for a long time, right? So, but every single time this indicator been green, it shows a buying opportunity. So there is an opportunity here. Okay, right now, let's check what happened. So we've been briefly into this green zone from January to end of February, basically, right here, right? So if you actually were buying here, let's say if you DCate here, your average price would have been, let's say around like $80, right? And then the price went up, and recently it went to 106, right? So around $20, let's say, above your average price, and that would be 20 over 80, you get like 25% return, right? And because why I say 106, because 106 was when this indicator came back to 0, and 0 means fair value. If it's way above 0, it's overvalued. If it's way below 0, it's undervalued. Right now, again, it dipped down, back down to negative 86, right? That's today it's 22nd of April, and we're at, this indicator shows negative 8.086, right? So, but that's just what we look at, but let's check it statistically. We can see different scenarios again. We can see that if you enter and DCA into the stock when it's below 0 and exit above 1, we get 10 instances in the whole history of the Netflix. And you would get, on average, you would get a 47 return, right? 47%. And we can see different scenarios. But right now, we are at negative 86, right? Let's make a hypothetical scenario here, right? Let's do the crossover. Let's say we don't want to DCA into the stock and we just want to buy into it once and see what happens later, right? So it's negative 86. If we, and it went down to negative 86, right? So if you buy into stock when it crossed down to negative 86, and then let's say we want to wait up to its cross until it cross up to 0. Let's see how would have been our returns, right? So this setup that I just explained happened 34 times in the stock history. The duration, the average number of days between entry and exit per trade would have been 141 days, and you would have made on average 38% return. Okay, so if you buy in right now and forget it, based on the history, you should make 38%, right? But it's not guaranteed, right? Because that's the average. There were instances that you would lose, as you can see here. From this 34 times, 3% of times you would lose more than 15%. 6 times you would lose 5 to 0%. And the rest you would win. 3% you would win up to 5%. Another 3% of the time you would win up to 15%, 5 to 15%. And over 85% of times, the return on your money would have been above 15%, right? So, statistically speaking, there's a high chance that if you buy right now, you would make a good return on your money. However, it is not guaranteed, right? When we're doing investing, we're talking about statistics. We're talking about chances, right? So you wanna invest when you have the best chance of making a good return. I'm giving an example here to just see what's the difference. So the same Netflix stock, if you were to buy, if it was overvalued, meaning if it was going cross up 0.85, and let's say you would wait at the same amount of day, 141 days. Then instead of 38% return, you would have get 18% return. And you could still make more than 15%, but the chance is much lower than the previous strategy, right? So that's what I'm talking about when we're talking about the investing and talking about chances and statistics. You need to have a good statistics to guide you through the investing. And here I'm sharing with you the stats and the chances that you would make money, you would make return on your money if you buy Netflix right now, right? There is a chance you would lose, but chances are less than if you were to buy when P/S ratio was above 0.5 or 1 compared to the 2 years average, right? Yeah, so I think I'm gonna wrap it up here. I hope you enjoyed this content. Please let me know what you think, and I'll see you next time. Bye bye.